Ever felt lost in the financial jargon? Today we unravel the mystery behind common investing terms. As we step into the world of finance, it's like learning a new language, but don't worry, it's not as complex as it sounds. Knowing these terms is critical, not just to sound smart at dinner parties, but to make informed decisions about your money. From stocks and bonds to mutual funds and ETFs, we'll break it all down. Ready to decode the language of finance? Let's dive in. Stocks and bonds, ever wondered what these actually mean? Let's unravel their mysteries. When you buy a stock, you're buying a small piece of a company. You become a shareholder, owning a slice of the company's assets and earnings. Stocks can be a bit of a roller coaster ride, with their value fluctuating based on the company's performance and market trends. But if the stars align, they can offer substantial returns. Now, let's turn to bonds. Imagine lending money to a friend who promises to pay you back with a bit of interest. That's essentially what a bond is, but in this case, you're lending to entities like governments or corporations. Unlike the thrills and spills of stocks, bonds promise to repay the original investment after a fixed period, plus regular interest payments. They're generally considered safer than stocks, but the trade-off is that they typically offer lower returns. So stocks are a bit of a gamble, while bonds are the steady, reliable friends in your investment portfolio. Next up, mutual funds and ETFs, two popular investment choices. So what are these exactly? Mutual funds are like a big pool of money collected from many investors. This pool is then used to invest in a variety of securities, including stocks, bonds, money market instruments, and similar assets. It's like a group project, where everyone chips in to achieve a common goal. Now let's talk about ETFs. ETF stands for Exchange Traded Fund. This is also a collection of securities, such as stocks. But there's a twist. ETFs often track an underlying index like the S&P 500. It's like having a guide to navigate the investment landscape. Now you may wonder, what's the difference between these two? Well, mutual funds are typically actively managed, meaning there's a professional deciding what to buy and sell. ETFs, on the other hand, are often passively managed. They simply follow the index they're tracking. Also, ETFs offer more trading flexibility. You can buy and sell them throughout the day, just like stocks. Mutual funds, on the other hand, are only bought and sold at the end of the trading day. Think of mutual funds and ETFs as a pre-made investment meal ready for you to consume. Now let's talk about the returns on your investments, dividends and interest. Dividends can be thought of as a slice of a company's earnings that are distributed to shareholders. They represent your share of the company's success and are a way for companies to share their profits with you. However, dividends aren't a sure thing. They hinge on the company's profits and the decisions of its board of directors. On the other hand, we have interest, which is essentially the price you pay for the privilege of borrowing money. It could also be viewed as the reward you receive for lending your money to a company or government entity through bonds. The key difference here is that interest is typically set and known in advance. It's a contractual obligation that the borrower must fulfill, no matter how well or poorly they perform. So, let's sum it up. Dividends and interest are the two primary ways you can earn returns on your investments. They're the rewards you get for investing your money. Dividends are a share of a company's profits, while interest is the cost of borrowing or the reward for lending. And remember, while the amount of dividends can fluctuate with a company's performance, interest is usually a fixed rate that you'll know in advance. In essence, dividends and interest are the rewards you get for investing your money. So, we've covered a lot of ground today. Let's quickly recap. We kicked off with a brief introduction to investing terms, laying the foundation for our journey into the realms of finance. We then dove into the world of stocks and bonds. Stocks, remember, represent ownership in a company, and bonds are essentially loans you give to a company or government in exchange for interest payments. From there, we ventured into the territory of mutual funds and ETFs. Mutual funds are investment vehicles that pool together money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. ETFs, or exchange-traded funds, operate in a similar manner but are traded on an exchange like a stock. We then shed light on the role of dividends and interest. Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. Interest, on the other hand, is the cost of borrowing money, usually expressed as a percentage of the loan amount. It's crucial to grasp these terms, as they form the backbone of your investment journey. Understanding them not only helps you make informed decisions, but also empowers you to navigate the financial landscape with confidence and ease. Remember, knowledge is power. The more you understand these terms, the better your investment decisions will be. Until next time, happy investing.